today is very, I mean, at least for now, is a bit clear. There's oil stocks where there's a bit of a problem, in fact, quite a bit of problem. Those stocks have not recovered. But X of that, the market is quite okay. Advanced decline is at now about 1:1. You have the Nifty, which is down, of course, 88 points. The Bank Nifty is almost in the green, and the mid-cap index is down only 1/3 now. In fact, the BSE advanced decline is now in favor of advances. Ashwani Gujral, Mitesh Thakkar and Sandeep Wagle with us. Ashwani, your first trade on the Nifty Bank was to buy. You're sticking with it? And what's the call now for index and individual stocks?
See, today's interesting bit is that the Bank Nifty has not made a fresh low. In fact, has held yesterday's low. So that's a sign of strength. I think the market tested, lower levels just to see whether there's more downside. And now it seems to be concluding that for the moment they can rally higher, and financials and consumptions, the pockets that have been hit, they could see a lot of short covering. So actually the real rally is still to begin. And my sense is that overall at lower levels, bears are realizing that there is no fresh traction. Having said that, IndusInd Bank is a buy with a stop of 1595, target of 1640. Canara Bank is a buy with a stop of 225, target of 241. And Bank of Baroda is a buy with a stop of 102, target of 109.
Okay, well, in some of these names, names like Eicher Motors, etc., there's a bit of a recovery that you're seeing. Eicher Motors is now up 2.5%. Titan is also your big mover post that Q2 update. And names like Pidilite, etc., are seeing some buying interest. So interesting, the kind of stocks that are moving. Mitesh Thakkar and Sandeep Wagle are also with us. Mitesh, would you buy Eicher Motors at this price? And what are the other stocks that would sort of attract your attention today?
Yeah. So Sonia, I think most of these stocks which have fallen a lot, I think they can be bought from a trading point of view, given the fact that they are extremely oversold and the hourly charts are now showing some kind of reversals. Actually, if somebody wants to buy, I think keep a stop below 22,000 and look for a trading bounce back to about levels of 23,500, 600. I think then we'll take it from there. Eventually it might go slightly higher, but I think overall the pattern is still weak on the medium to longer term chart, so fresh lows will happen after some point in time. The trades which I have right now are a buy on DV's Lab with a stop at 1275 for targets of 1340, and ACC remains a sell. It's fallen off a bit, but around 1490 would be a good sell. Keep a stop at 1507 and look for 1450 as the target.
Okay. Actually, I had two more stocks to check with you, SBI Life and Sun Pharma.
See, today is a bit of a financials day. So, staying with banks will help. But SBI Life, it's been in a strong downtrend. It's gone up for about 4 days. So, possibly another, 1 or 2 days can happen. But basically, it's way ahead in the pullback compared to the banks. And Sun Pharma is overall a stronger stock than the rest of the market. And apparently, there is some good news that has just come in.
Correct.
So my sense is that with a stop, say around 550 thereabouts, I think whenever the market recovers, Sun Pharma could do better than the market.
Okay, couple of more stocks, Ashwani, Avenue Supermarts and also Jubilant Foodworks.
See, Avenue Supermarts was a call in the morning, and it's had 7-8 sessions of relentless selling, and after that it's showing some sort of bounce back. Can easily get back to 1450. Similarly, Jubilant Food on a day when things are pulling back, we could get back towards 1220, 1230. But essentially all of these things are pullbacks, and today seems to be a good day to participate on the upside on them.
Okay, well, both on Sun Pharma and on Vivimed, there's positive news flow. On Sun Pharma, the US FDA has reclassified the Halol unit as a no action initiated. So that is the reason why the stock is up. And on Vivimed, the Mexican unit has received an establishment inspection report, which is a positive report from the US FDA. That stock is up about 4%. But Sandeep Wagle is also here with us. Sandeep, hi, good morning. What are the stocks that you would be trading right now?
Good morning, Sonia. I would go with a sell in a JSW Steel, stop loss of 377, target 360, and a buy in a Balrampur Chini, stop loss 75, target 87.
Okay. Gentlemen, thank you very much for joining us with your 10 a.m. trades. It's a very interesting market. We're taking a quick break and coming back with someone who has watched this market for long and from a distance. Brian Jacobsen of Wells Fargo joins in to talk about the impact of rising US. There's still red on the screen in spite of the little bit of help we have got from crude prices. But how are things panning out in early morning commodity trends? Manisha Gupta joins us with a roundup. Good morning again, Manisha.
Thank you for that, Lata. Well, yes, we did see a steep correction in the crude oil prices overnight in the New York session. But come Asia, and you have seen buying come in on those lower levels. So 0.5% up for the US and the Brent prices. And that's exactly what we have seen happen here as well. And that is what the markets are anticipating, that until 4th of November, until the Iran sanction deadline number, final number on what how much has been knocked off the international markets, until the market doesn't have that number, you will continue to see this volatility in the markets. In any case, because the speculative longs are near record highs, so any bit of a good news does tend to lead to a lot of volatility there. So $2 to $4 of a move on an everyday basis is something that the markets really are readying themselves with. But it doesn't really end on 4th of November as well, because you have the OPEC and allies meeting in the month of December to decide on what their course of action would be for the rest of year, that is the next year 2019, on whether or not they would go on with their output cut agreement of 1.8 million barrels that they have right now. So the year end really is going to, until then, is going to be quite eventful there. The strength in US dollar, the kind of data that we have seen in sense of employment and the non-farm payroll data today, in anticipation of that, you already have seen some profit taking come in for the precious metal prices. 0.5% down is how we are trading in the global markets, and that's exactly what the Indian prices have been mirroring here. In the Indian markets, though, because the physical buying has started to pick up, you are looking at some kind of a premium building up. But in the international markets, it continues to be quite under pressure. $1,200 per ounce has been a difficult level to close above. The base metal prices, while this week has been good, and we have the aluminum prices up 5.5% in this week, trading around 3-month highs. Same is the case with copper prices, up 3.5%, up at a 3-month highs onto that one as well. But today, of course, we have gone in for a profit taking, and that clearly has been because of the US Treasury yields, the China concerns, where you have seen some slowdown numbers come in. Also, the US-China trade concerns, the rising US interest rates, and of course, the non-farm payroll data today in the evening is expected to be on the positive side. So ahead of that, you have gone in for some profit taking here. Just to remind you that the individual fundamentals here are on the stronger side. Demand also seems okay, but it really is about the market sentiment, the macro, that really seems to be bothering this sector at this point. Trading strategies, and we have them from ComTrends. They have a buy call in case of gold. 31,300 is they're watching out for. But at the industrial commodities, they have come out with sells. In case of crude, the downside target comes at 5,400. It's a sell call for copper as well. 451 is the level that they're watching out for.
Okay, Manisha, you go for gold and let's see how things pan out. At the moment, the interest, of course, is maximum in emerging markets, and the fact that they are selling off because of US yields. There may be a temporary stop today, but we wanted a view from afar. Brian Jacobsen, Senior Investment Strategist at Wells Fargo Asset Management, joins us, long a follower of EM Equities. Brian, thank you very much for joining us. Well, as I just said, EM currencies and equities were roiled for the last several weeks because of the spike in US yields. Now, first tell us if there is more to come in terms of US yields, and therefore will there be even more risk aversion or continued risk aversion towards EMs?
Well, I'm actually kind of hopeful that we might be close to a turning point with sentiment towards the emerging markets. I believe that a lot of the moves in the 10-year Treasury yield market in the United States were more a matter of just rapid changes in positioning of certain short-term investors. And it was a very large move, very abrupt, but it's one that I think might actually reverse itself. And as a result, I think that we could actually see a little bit of a rebound in the emerging markets, broadly speaking, both on the equity side and on the currency side. I think that as of the end of August, at least from speaking for my team, the multi-asset solutions team here at Wells Fargo Asset Management, we've been looking for an opportunity to re-enter into emerging markets, both on the debt and equity side, and including the currencies as well. We're hopeful that in September that might have provided some opportunity to form a bottoming pattern. But as we know, sometimes when you have a bottoming pattern, you can sometimes feel like the rug is being pulled out from under you. And I think that's kind of what happened over the last couple days here. So we are optimistic about the outlook for emerging markets over the long term. We're just really sort of biding our time, waiting for the right opportunity.
Okay, so optimistic on emerging markets, and this could be a turning point. Brian, thanks so much for joining us. You know, the incoming data on the US is very strong. Can this push the US yields much higher before they cool down eventually?
We actually believe that the 10-year Treasury, at the beginning of the year, we were expecting that it could rise up to as high as about 3.25%. So we're not all that surprised that we're up to about 3.18. If we get up to 3.25, to us, the real question is how much further would we go above 3.25%? We don't think that there's a lot of room for it to go much higher than that over the course of the next year or two. And as a result, we think that we might be towards the top end of a range. Now, these ranges can be fairly wide. We've seen just a month ago, we were close to about 2.8% on the 10-year Treasury. Now we're up to about 3.2%. But we believe that range that we're going to be trading in for the balance of the year is likely between 3 and 3.25%.
You know, that's so good to hear, because the sudden rise has clearly roiled EMs. You know, you said that EMs are close to a turning point. Now, which EMs would you buy first?
I think that actually the markets that we'd enter first, it's more a question of the economic exposure as opposed to the purely geographic or country exposure. A lot of the areas where it's been very closely tied to trade with China has been beaten down. And so India has gotten caught up in that, Malaysia, Indonesia, Vietnam, parts of Korea. So a lot of the more Asian emerging markets have really been dragged down in sympathy with China. You have other emerging markets that have been dragged down more due to their own political reasons. And so those could be areas like Turkey, Egypt, South Africa, Brazil, Argentina. So we'd actually prefer to look more at emerging markets Asia as opposed to looking at more the broader basket. And it's because of the differentiating, trying to distinguish between the political risks, which you find in a lot of countries, more in Latin America, Middle East, North Africa, as opposed to in Asia, where it seems to be more economically driven. And so we're optimistic about the economic growth outlook. We think that the U.S. and China will come to a resolution probably before the end of the year with the trade dispute, and that should give a general lift to EM Asia.
Well, the big worry for emerging markets like India is crude, right? I mean, India has been a big casualty of higher crude prices. So before I ask you about India, what's your take on crude? Does it go much higher from here?
Crude oil, we've actually been long crude oil in a lot of our portfolios when it dipped down below about $68 lately. So we've been able to ride that up to 75. I'm not sure how much higher it will actually be able to go. So we usually look at West Texas Intermediate instead of Brent crude. But broadly, you know, the two go hand in hand with each other. We could see a further move up of maybe about 5 to 10%. But I don't think that we'd go much higher than that. That has been weighing on a lot of the oil importers, countries like net importers like India and Indonesia, mainly because of it's such a large portion of what they import, and that higher cost can be a drag on growth. So we think that there is still some upside for oil, but in terms of the balance of risks, I'd say that it's pretty evenly balanced between the upside and the downside, where we would expect that crude is going to trade in a range between -5% and +5% of about where it is today.
No, that's good to hear, that not more than perhaps 5% from current levels. So, will you buy India? And right away.
India is one of the areas that we've actually liked for a long time. Last year, it served us very well by having a bigger exposure to India. We did lighten up on that exposure going into 2018 because we were anticipating some more of these political issues flaring up between the U.S. and China, and we were concerned about the knock-on effects to countries like India. And India, unfortunately, is in a position where I think a lot of people view India having a high current account deficit and also a budget deficit as being particularly vulnerable to weakness in the emerging markets. Now, I think that they do have quite a few things going for them as far as a growing population, very good growth rates, a credible central banker who isn't necessarily going to try to deliberately depreciate the currency. But right now, the big concern is, I think, those vulnerabilities on the current account deficit, the exposure to oil imports, the budget deficit. And then you also, unfortunately, have them caught up in the broader EM weakness as far as with just negative sentiment. But when sentiment turns, it can turn rather abruptly. And that's one of the reasons why what we've been encouraging our clients to do is, if you have EM exposure, if you haven't gotten out, stick with it, because we do believe that we will be forming a bottom. It's just a question of, is it a matter of a few weeks or is it a matter of a few more months?
Oh.
So, some fund managers fault India for its high valuations. Does that deter you as an investor at all?
So India has also been hurt by, as far as with the rupee hitting some historic lows versus the dollar. But to be perfectly honest, I think that India's valuations, just considering the makeup of the market itself, should be at a slightly higher valuation. India has a lot more tech exposure in its indices than what other emerging markets do. Most other emerging markets are going to be very heavily biased towards lower valuation securities, like in the utilities, banking, and telecom area, or more commodity-related industries. And so India has just historically had just more of that technology exposure, which does command more of a premium valuation. And so when I look at valuing India, I usually look at it as far as what does it value on a relative basis to its own history and relative to other tech sectors in other emerging markets. And on that basis, I don't really see it being overly valued.
Okay, then in that case, what would you buy in India if and when the tide turns? Would it be tech or would it be something else?
Yeah, so it's sort of when the time comes, that's when we make the decision, because you never know how things will shake out until, as you said, until maybe the dust settles a little bit. But we do have a bias more towards the build-out of infrastructure in India, the build-out of more consumer staples and consumer discretionary. So if I had to pick a few sectors with India, I'd say technology is always going to be of interest just because of the innovations that take place in India. But then in the industrials and then in the consumer discretion area, those would probably be our three favorite sectors to be focusing on. But it is a matter of, I think that right now a concern is the health of the shadow banking and the banking sector in India. That's been a constant worry of investors over the last few years. So I think that there's still ways to go until those worries dissipate.
Oh, absolutely. In 2003, the super US growth spread to a lot of the other countries. This time it appears that the US is growing at the expense of emerging markets with whom it has trade tiffs. Now, many economists believe that the slowing emerging markets can well slow down the US too. Which scenario, according to you, will play out?
The interdependencies is really fascinating to watch, and as you point out, 2003 to 7, better growth in the U.S. led to better growth in the emerging markets. And right now, what we really like is the idea that the markets themselves have, we believe, improperly priced in that there is going to be this drag on EM growth because the U.S. wants to grow at the expense of its trading partners. Now, that has been somewhat of a stated policy of the Trump administration, is that they think that countries like China have been sapping and dragging on growth in the U.S. But, I mean, the fact is that there are mutual gains from trade, and these interdependencies mean that the U.S. really cannot grow robustly without benefiting a lot of the emerging markets. Now, there are some that will not benefit as much from it. China is one of them that probably won't benefit as much from growth with the United States. And there are other countries as well, as far as, say, in the Middle East or in Venezuela, in other select countries where they're not going to benefit from strong growth in the U.S. But I think that a good trading partner, one that we have very good political relationships with, like India, would stand to benefit very greatly from better growth in the United States.
Okay, that's good to hear, actually, Brian. So one final question. Has the Indian rupee fallen enough for you to buy Indian debt assets, as you said, or Indian equity assets?
I think that a lot of emerging market assets do look very attractive from a local currency perspective. So meaning that we don't just anticipate that there could be in the making a rebound in, say, the equity prices, but also in the currency. So we're looking at the rupee itself. I think that on a purchasing power basis, so you inflation adjust it, you look at relative interest rates, a lot of these sort of a spectrum of indicators that we look at as far as the value of emerging market currencies. Broadly, I think emerging market currencies in India particularly, they do look attractive at these levels.
Okay, well, on that optimistic note, we will thank you and let you go. Thanks so much, Brian, for joining us. So they are quite bullish on emerging markets like India, and they believe that India is not overvalued, as a lot of experts think. So